The fortune buried in a forgotten asset. It started with silence. No headlines, no excitement, just an asset the market had abandoned, ignored so completely that most investors forgot it still existed. This story matters now because the greatest opportunities rarely announce themselves. They hide where attention fades, where disappointment lingers, and where patience feels pointless. In today's market, driven by speed, hype, and constant noise, understanding how forgotten assets can quietly transform fortunes reveals a truth most investors overlook. It began after a long collapse. Years of poor performance had pushed the asset out of favor. Funds exited. Analysts stopped covering it. Trading volume dried up. What was once considered essential became an afterthought, left behind as capital chased newer, shinier ideas. The consensus was clear. This chapter was over. But one investor saw something different. While others saw a decay, he saw imbalance. Prices had fallen far below intrinsic value, not because the asset was broken, but because belief in it had vanished. He studied long-term cycles, supply constraints, and demand patterns no one bothered tracking anymore. The data whispered what the headlines did not. The asset wasn't dying. It was waiting. Quietly, he began accumulating. Not in a rush, not with leverage. Just steady purchases over months, then years. Each position felt lonely. Each trade was met with skepticism. Friends questioned his sanity. Advisors warned he was tying capital to a relic of the past. But he wasn't betting on revival through hype. He was betting on inevitability. The early reveal came when small disruptions began appearing at the edges of the market. Supply tightened. Costs rose. Replacement became harder than expected. Nothing dramatic, just subtle shifts that only mattered if you were already paying attention. He was, and as those subtle shifts grew more frequent, the forgotten asset began to stir, slowly, quietly, but with a force that would soon be impossible to ignore. At first, the movement was barely visible. Prices edged upward in small, uneven steps, often giving back gains just as quickly. To the outside world, it looked like noise. To him, it looked like pressure building beneath the surface. The reveal deepened when industry data began to shift. Production numbers fell slightly below expectations. Inventories tightened. A few large buyers quietly returned, locking in long-term supply agreements without fanfare. These weren't speculative moves. They were defensive ones, signals that something essential was becoming harder to secure. Still, the market remained dismissive. Analysts attributed the changes to temporary disruptions. Commentators called the price action meaningless. Funds stayed away, scarred by years of underperformance. The asset carried a reputation that was hard to shake, and reputation, once damaged, lingers long after reality changes. The early conflict emerged when volatility returned. Prices surged suddenly, then snapped back with equal force. Traders jumped in late and exited early, reinforcing the belief that nothing had truly changed. Each pullback was labeled confirmation that the asset's brief strength was an illusion. But beneath those swings, the foundation was tightening. Supply responded slowly. New capacity took years, not months. Costs climbed. Margins compressed for producers who had cut investment during the long downturn. The system had been optimized for decline, not recovery. The investor stayed patient. He resisted the urge to scale too quickly. Instead, he reviewed every data point with growing confidence. The asset wasn't just rising, it was becoming scarce. And scarcity, once recognized, has a way of rewriting narratives faster than any headline ever could. The conflict sharpened when a geopolitical shift disrupted a key supply route. The event didn't dominate the news cycle, but its impact rippled through the market immediately. Prices jumped. Liquidity thinned. Buyers who had waited too long scrambled to secure exposure. For the first time in years, the forgotten asset was no longer ignored. It was being chased. And the distance between those who had waited patiently and those just waking up was widening by the day. The tension peaked as the market began to realize what it had missed. Price movements grew sharper, less forgiving. What once drifted now surged. What once corrected gently now snapped back violently. The asset was no longer asleep. It was awake, and it was testing conviction on both sides. The conflict intensified when institutional interests finally arrived. Large funds that had ignored the asset for years began building positions, moving cautiously at first, then with urgency. Their entry shifted the balance overnight. Liquidity tightened further. Volatility spiked. The same scarcity that had gone unnoticed now magnified every trade. With that shift came instability. Rapid price increases drew short sellers who believed the rally was unsustainable. They pointed to history, to years of disappointment, to cycles that had always ended the same way. For a moment, it looked like they might be right. A sudden sell-off erased weeks of gains in a matter of days. Headlines declared the move over. Doubt flooded back in. But this time was different. The pullback didn't bring relief. It brought demand. Buyers stepped in immediately, absorbing supply that once would have crushed prices. The asset refused to fall the way it used to. Each dip became shorter, each rebound stronger. The market wasn't just repricing, it was relearning. The investor watched closely, aware that this phase was the most dangerous. When forgotten assets return to relevance, the transition is violent. Conviction is tested. Weak hands exit. Strong hands absorb. Fortunes are made or lost in moments of hesitation. Then came the moment that confirmed everything. A major end user publicly acknowledged dependence on the asset, warning that shortages could disrupt entire industries. The statement wasn't dramatic, but its implication was explosive. What had been treated as optional was suddenly revealed as essential. Prices surged again, this time with a different tone. Less speculation, more urgency, less excitement, more fear being left behind. The market had crossed a line. The asset was no longer forgotten. It was becoming unavoidable. The climax arrived with clarity that left no room for doubt. A supply report confirmed what the patient investor had known for years. Reserves were lower than projected, replacement capacity was years away, and demand was accelerating faster than anyone had modeled. The gap between availability and necessity snapped into focus. Prices reacted instantly, not with frenzy, but with force. Contracts repriced. Long-term agreements locked in at levels once considered impossible. The asset didn't just rise, it reset. What the market had dismissed as obsolete was now dictating terms. For those who arrived late, the move felt unfair. They chased, hesitated, and paid higher prices with every step. For those who had waited, the shift felt inevitable. The investor watched his position transform, not through a sudden spike alone, but through sustained repricing that redefined the asset's role in the global system. The resolution came quietly. Media coverage caught up. Analysts rewrote narratives. The forgotten asset gained a new label: strategic, essential, irreplaceable. But labels didn't matter anymore. What mattered was a lesson written into the charts. Markets don't reward attention. They reward patience. They punish crowds. They elevate those willing to endure boredom, doubt, and years of silence. The fortune wasn't found by predicting headlines. It was built by listening to what the market stopped talking about. In a world obsessed with speed, the greatest advantage had been time. And as the asset settled into its new reality, the investor understood something most never do. Opportunity rarely arrives loudly. It waits quietly, buried beneath neglect, until only the patient are left to claim it.